welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for that common sense approach to planning with our money, our investments, for our financial and retirement future. He is president and founder of McIntire Retirement Services, Chris McIntire, here with us. And Chris, always appreciate your time. The end of the year, really at this point, right around the corner and rapidly approaching. So I know you're busying yourself with client matters, trying to help check off those end of year to do items.
Yeah, there's three main ones that we're looking at right now. Number one is Roth conversions. Number two is required minimum distributions. Number three is qualified charitable distributions, which can help satisfy that required minimum distribution. So that's a lot of administrative work, probably more work for the staff than it is for me in some of those cases. And thankfully, we got a good staff here to help everybody get those things accomplished.
Well, Chris, I know that staff has grown over the last year to help facilitate serving more of Northwestern Ohio's savers and investors and making sure that you have the ability to help more proactive savers formulate those plans. So, ladies and gentlemen, if you would like to get that plan put together, or if you have not taken care of those year-end to-do items, it seems like all in the name of taxes and tax planning and tax management, right, Chris? Give Chris McIntire Retirement Services a call, 800-868-1194. That is 800-868-1194, 800-868-1194. And Chris, it does seem like between maybe Halloween and the end of the year, other than on April 12th through 15th, this is the only other time of year where people try to or want to think about taxes.
Yeah, that's a very good perspective there. The mad dash there at the end of the tax filing deadline is certainly crazy for individual filers. And as many times as you and I have talked about different tax issues here on the radio show, our clients are certainly more aware and taking advantage of, speaking to the accountant on Roth conversion opportunities and, how much money do they have in the current tax bracket they're in. And then you look at, okay, does it make sense to look at converting some of their traditional IRA money into a Roth IRA? And, the reason you would want to look at that is, Roth IRAs do not have required minimum distributions, okay? Traditional IRAs do have required minimum distributions, and those dollar amounts cannot be converted into a Roth IRA. So, for most folks, when you hit that age 59 and a half till about 73 now, when required minimum distributions start, probably have your greatest opportunity for Roth IRA conversions. We're not talking about contributions here, folks. We're talking about converting from a traditional to a Roth IRA, which creates a taxable event, which is why we have to involve the CPA in that to see, does it make sense? Are we jeopardizing Medicare premiums, Social Security taxation, and obviously the income taxation as well?
But Chris, that does have a hard deadline, must be completed within the calendar year. So we got to get a move on that because we cannot wait until December 31st to start the process. In fact, most of these financial institutions have a deadline to receive requests for Roth conversions well beyond or well before that deadline, sometime in many cases, late November or early December?
Yeah, we like to have this stuff done like the first week of December because, they do have hard, fast deadlines to say, look, we're not going to guarantee it can be done from mid-December on, right? You have so many more people around the holidays, right? Productivity drops. It just naturally does. You probably get more, internal folks taking time off around the holidays as well. So it is just simply harder to get things accomplished. So, we want to have all these things done here in the month of November. Then it gives us just a little bit of a bleed over time frame, but, keep the stress level down for everybody.
Well, certainly worth a peek, ladies and gentlemen, to see that report on how you could proactively control and manage your tax liability on those tax-deferred retirement dollars, control taxation on Social Security, control cost of Medicare premiums, and control level the IRS has over you moving forward with those required minimum distributions and RMDs. So again, if you would like to take a look at those reports, at the analysis of the cost comparison to deferring and delaying that tax bill or being proactive with it and controlling it ahead of time, pick up the phone, give McIntire Retirement Services and Chris McIntire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Now, Chris, you have a great report that covers 5 planning mistakes to avoid that we wanted to discuss on this program. And bottom line, nobody likes to make mistakes. If we can avoid some of these mistakes, especially these big ones that are listed in this report, then we significantly increase our likelihood for lasting financial confidence and retirement success.
Yeah, Peter, and what we call the first one is, not having a grip on your retirement. And GRIP is an acronym, which means a guaranteed retirement income plan. Not everybody's going to retire with a big fat pension and Social Security, if you will. So they will need to generate some income out of what they have invested and saved over the course of their working years. And then in retirement, how do we transition to, building an income plan that complements the investment plan? So a lot of times in our world, what we're talking about here today, these could be 2 separate items. And, as the interest rates have increased, boy, this, we're really hitting a sweet spot to get one of these plans implemented, with 10-year government bonds paying 5% interest. It's a sweet spot for annuity payouts. We're having to use less money to get more income paid out. So, it's certainly worthy of taking a look at these right now more than any other time, Peter, in the last probably 20 years.
Yeah, and I like the acronym, and I like the play on words. Certainly, you want to have a handle on your pension situation. If you do have one, if you don't have one, a handle on your Social Security situation. How can you work that to optimize the income? That is the GRIP, the Guaranteed Retirement Income Plan. You want to get a grip on that, the guaranteed portion, and then figure out what you need to generate over and above what you have coming in that your assets are not going to be responsible for. And like you said, Chris, a very opportune time with these interest rates to take a look at this and perhaps lock in these higher interest rate opportunities for the payout of income. I know you've got a lot of solutions there, Chris, and you can go several different directions, kind of up and down the scale of how much risk somebody wants to take with generating that income. But bottom line, across the board, because interest rates have improved, so has the ability to generate retirement income right here, right now. But that could change into the future again.
Yeah, it certainly can. And I'll give you a quick example. So, most people listening to the show today are familiar with the 4% rule, which means you can draw out 4% of your investment portfolio and adjust it for inflation. Okay. And, obviously in a low interest rate environment, it wasn't anywhere near 4%. It ended up being about 2.8 actually. Okay. So you said, okay, I got $500,000 at 4%. Okay, I can pull out $20,000 a year, adjust it for inflation. Okay, well, one of the annuity payouts on a 60-year-old, okay, is going to be 6.8% with the ability to have increasing income as well, right? So on $500,000, that's what, 34,800. Okay, I mean, look at that, folks. It is time to reconsider this. I've got folks out here that are anti-annuity. I'm like, nothing can do what that can do, though. I mean, this is a different environment. This is not your parents and your grandparents. This is modern day income planning for an entire generation that doesn't have pensions. It really is time to look into this further and take it serious.
Right. And moving, Chris, from a 4% cash flow rate to a 6% cash flow rate, we may not have a full understanding of that, or, percentages and numbers in general don't translate well over the radio. But that's not 2% more money each and every month in retirement. That is 50% more money year after year through the decades of retirement. That is a significant increase in the amount of income a portfolio value can generate. So again,
Yeah.
now's the time to really look at these options and examine them.
Absolutely. And fixed rates up there, very handsome looking as well too. So, boy, we can really do a lot of nicer things, safer things, provide more peace of mind than what we've been able to look at here over the last, basically since the financial crisis of 2008 in all reality, where interest rates went to the bottom is my point.
Yeah. Chris, I mean, for many years it seems like the old adage and the hope of protect the principal and live off the interest was all but maybe impossible right next to it because the interest rates were so low. But this is once again a reality for many people.
Yeah, it really is. And, it's much easier to do. I guess you could say we're probably lessening the risk exposure in portfolios, which is kind of number two here, taking inappropriate risk. And, that's something that's favorable in a higher interest rate world is, hey, we can generate income a lot easier and more stable type investment pieces. Some of them even, a CD is safe from market risk, so there are, it's a lot of different aspects and different ways to look at things based off of liquidity options and, things like that that the individual client's going to need to meet their goals and wishes, of course.
Yeah, again, if you would like to explore these options, ladies and gentlemen, if you would like this report on the 5 planning mistakes to avoid, pick up the phone, give a call to McIntire Retirement Services and Chris McIntire, 800-868-1194. That's 800-868-1194, 800-868-1194. Transitioning nicely there. Yes, Chris, from the getting that grip on your retirement, understanding your sources of guaranteed retirement income planning, the pension, the Social Security, to number 2 of the 5 planning mistakes to avoid, taking inappropriate risk. It's kind of like that Goldilocks scenario, right? A lot of people take far too much risk. Some people take far too little risk. We want to get this one just right. We know that there is sort of an appropriate place, time and place for risk in our financial lives and with our money, but we don't want to overdo it. And for all intents and purposes, there are times and reasons why we don't want to underdo it either.
Yeah, no question about it, Peter. Um, as we look at what was used to be the rule of 100, and you would say, okay, I'm a 60-year-old, I'm going to take 100 minus 60. That'd be 40% in stock, 60% in bonds, if you will, or vice versa, depending on the overall risk tolerance of the individual there. But that's kind of the rule of 100. And as we're hearing, coming up on the end of 2023, we've essentially had 3 negative years of performance in the bond market. So, the more conservative investor could be down more in value than the more aggressive investor, just, because of that shock in the interest rate cycle, what it did to the bond market overall. And, as we were meeting with clients here in the third quarter, we talked about, look, now's not the time to capitulate and say, all right, I'm done. I want to put it all into a CD, and we could be entering into what is typically the most favorable part of the stock market. And bonds will eventually come back as well. And so sometimes you just simply, have some, a gut check and say, look, what am I in this for? What do I want to do? Because it's very easy to say, all right, well, the heck with all of this, I can make 5% in the CD. Okay. Well, but what if next year bonds recover 15%? And even if stocks just stay even in a 60-40 portfolio, all right, that's a pretty steady rate of return, and bonds are renewing at higher interest rates. So you could be certainly increasing your rate of return as well, just by the interest rate aspect.
These are things that we either have to pay attention to or rely on a source for guidance that pays close attention to them, ladies and gentlemen. And that's what Chris McIntire does for his clients there at McIntire Retirement Services each and every day, for offices conveniently located across Northwestern Ohio, and something close by and convenient for you, or always the ability to have just a quick phone call for a few direct questions and answers, or the ease and convenience of a virtual meeting. So if you'd like to set up a time to speak with Chris personally, individually about your situation, start with a phone call. Pick up the phone, 800-868-1194, 800-868-1194, or you can skip the phone call, go online, McIntyre Retirement Services.com. Sort of coming around, circling back to our deadlines for year-end planning that we discussed at the beginning of the program, Chris, number three of the five planning mistakes to avoid is a gross planning mistake. Can you explain?
Yeah, a gross planning mistake is kind of what we opened the show with here. We talked a little bit about the Roth conversion is, grossly missing tax planning opportunities. If you're sitting here with a very large IRA account that you really don't need, and your goal is to pass that on to your children or your grandchildren, utilizing Roth IRAs, or even, taking your required minimum distributions and funding an income tax-free life insurance policy, is a way to take pennies and buy dollars. So, be open to some of these avenues that are out there. And just because, well, Dave Ramsey said I should only buy term insurance and invest the difference, or Susie Orman, look, you can't give that blanket advice to 300 million people and think that's the only thing that works. There are other avenues to consider with that. And, we're going to talk about another one of these five planning mistakes here in just a minute, where this life insurance aspect could also cross over. So, a couple, maybe take care of a couple of these issues with one stone, basically, and only one funding mechanism.
Yeah, again, talking with Chris McIntire, five planning mistakes to avoid. Chris, you've begun our segue already. Number four, not caring enough to plan for care expenses. Can you explain this one, and then talk to us about how we may be able to take care of a couple priorities with one initiative?
Yeah. So, when we say this, I say this personally, having, dealing with a long-term care facility on a monthly basis for, kind of a dear friend for many years. And knowing that there is a long-term care policy that they had planned for this, there is some genetics involved that pays the monthly bill in the nursing home almost in its entirety. And we're starting year number 5 now, coming up here in February. So, I mean, we're talking probably $400,000 has been paid out that wasn't had to liquidate from the estate, that will go to beneficiaries and benefactors. Okay. Um, so life insurance policies today, many of them have the ability to access a death benefit on a monthly basis, income tax free, for a long-term care need, assisted living, home care. Long-term care is a very wide piece. It's not just the nursing home side of things. So I have personally 2 of those myself. My wife has 1. If it didn't make any sense, why would I have them?
Yeah. Oftentimes, Chris, if not planned and prepared for and specifically addressed, the burden may first fall on to the spouse, or maybe then the extended family, the kids, the children's spouses, right? The daughters-in-law. I think statistically are the ones that most often provide care to family members, and that not only puts that burden on them, but also takes them out of their own peak earning years oftentimes, which then sets them back in their own financial preparedness for retirement.
Absolutely. And my wife spends a lot of time taking care of my father-in-law, and my brother-in-law is retired, so he does that as well too. To keep my father-in-law at home, but it takes time, effort, and money. And when you're taking care of somebody else, it's hard to take care of yourself. So there is that, a lot of times the caregivers handle so much more of the stress load than the one being cared for. And, I think we're all, everybody watching the show or listening to us on the podcast, can certainly relate to that. And, many of us have been humbled by that over the course of our lifetimes. And, you know, that's why planning to have some financial resources available to, help compensate loved ones, because some policies allow you to pay your loved ones to take care of you. Not all of them do. But having some sort of mechanism, if you're hiring some professionals, where you're not spending thousands of dollars out of the IRA account, and all of a sudden you don't leave anything for your beneficiaries, when that in all likelihood was a very unavoidable dilemma to be in. It's
Chris,
almost voluntary to do that to yourself.
yeah, but you also mentioned term insurance. I think that there is absolutely a time and a place for different types of financial products, right? If one was always right all the time, then there would be no other choices or options. That would just be it. And if one was always wrong all the time, it probably would not exist. I think term for younger folks, for income earners with a mortgage, with a spouse, with children, that's the highest bang for your buck, right? Is that you can get more death benefit per dollar of cost with term. But generally, the insurance companies understand that we are very, very likely to live through that term and then it expires or becomes astronomically expensive. Whereas what you're talking about here, um, in place permanently, number one, can cover those long-term care costs, not just a death benefit. It really is a reason why we may want to reconsider the need for life insurance into and throughout retirement, which is a time when I think a lot of people can somehow convince themselves that there is no longer a need for life insurance. Am I mistaken there?
We can make arguments for and against all of these, and you bring up the term insurance side. I have two term policies and two permanent policies. So, I agree with Peter wholeheartedly here. We build a house. I got a term policy to protect that mortgage in case something happens to me. And I can even convert it into a permanent policy if I needed to down the road, which is nice. So sometimes you can go the cheaper route and then all of a sudden do a conversion strategy if you needed to. Um, and you can make an argument that the need for life insurance should drastically reduce as time goes on. Um, in case of a death, for example, because you're out of debt, you've got 401ks, IRAs, other types of investments, the house is paid for. So you could say, all right, what do I need life insurance? If I pass away, there's no debt. My wife can live, without any risk, essentially. But now with the newer policies that we're utilizing today, having that long-term care aspect inside of it certainly brings another appeal to it. But also, if you've got a $5,000 required minimum distribution, you could reinvest that into a life insurance policy and buy tens of thousands of dollars income tax free.
And I've never seen a auto insurance policy, Chris. I mean, we're talking about insurance. We are protecting against an undesired event. Typically, when you talk about insurance, I have never seen an auto insurance policy that I pay those premiums, and if I sell the car and never get into an accident, they refund the premiums to me, or even pay me the benefit that they would have paid had I been in an accident. Likewise, a homeowner's insurance policy, right? We get that in case of flood or fire, but if we sell the house never having a flood or fire, they don't refund that amount or give us the amount of the insurance. That is what you're talking about here, which is perhaps reason in and of itself to re-examine this question and not make this mistake of not caring enough to plan for care expenses, because there is that quality with the modern approach to long-term care through that life insurance. If we don't have the event we're protecting against, there is still a value present and presented from having the coverage and protection.
Yes, yeah, without question there. You stated that very well, Peter. We typically, people say, well, how long do I have to pay into the policy? Do I got to pay into it for the rest of my life? That could be an option. A lot of times we accelerate the payments and get them out of the way, maybe pay it up in a 10-year, a 15-year, or a 20-year pattern, and then you're all done with it. Depending on the age and the health of the clients and everything that, what they're looking to accomplish. So there is a lot of flexibility, and you can tailor something like this to the individual. And, I've never had anybody, hand the check back and say, you know what, we don't need it anymore. And, our buddy Tom Hegna, who we've had on the show, and, he speaks at a lot of the conferences we're at, it says, the question you have to ask people is, how much life insurance do you want on the day you die, right? As much as you possibly could have, right?
Right. Yep. All right, moving down the list here, the 5 planning mistakes to avoid. Chris, we've covered 4 of them. Just to recap: not having that grip on your retirement, taking inappropriate risks, a gross planning mistake, not caring enough to plan for care expenses. Number 5 on the list: not using Social Security to provide effective financial security. Talk about this mistake, Chris.
Sure. Social Security and the filing of when you take that is a very important decision. It's almost irreversible. You can change your mind in the first 12 months. Now you can't go back and repay them and redo it later on. You only have 12 months to do that. So, especially for married couples out there, okay, to start this conversation is, do they both take it at 62 if they retired? They retired early and they're gonna delay taking. They need to take Social Security to make ends meet. Okay, is that the best strategy, or do they pull some money out of an IRA to supplement and then allow the spouse that has the biggest benefit to delay taking theirs 3, 4, 5 years to get a bigger benefit that would also pass on to the surviving spouse if they passed away? Okay, and we have several clients that have done that. That I'm thinking of as I'm even saying this right now, is that, look, we're going to live off the 401k a little heavier right now, to delay taking our Social Security until we hit 65 or 66. Okay. You can wait all the way up until age 70. So if we have somebody out there that may be, divorced or widowed or never been married before, their timing of Social Security is also very important, because, should something happen and they pass away, those benefits are going to stop.
No reason to wait past 70, right? If doing that, you are simply making a donation at that point in time, right?
Correct. Yeah, there'd be no reason you would want to wait, because your benefit's not going to increase anymore. You're almost throwing money away. And, some people are still working past age 70. They like what they do. So they're, if they are, they can still file for Social Security and delay taking and continue to work. Okay. And as they're working, then, their benefit will get recalculated because they're still contributing to Social Security, and their benefit will increase, as time goes on, once all that data gets reported to the Social Security Administration. Sometimes it takes a year, 18 months before they recalculate, because by the time they get all of that information, what the earnings were, run a different calculation, and all of a sudden you see a bump in your check. Had that conversation yesterday with some folks.
Well, again, we've got this report, this list of the 5 planning mistakes to avoid. Chris McIntire has made this available. We've been discussing it on the program. If maybe you didn't catch the entirety of the program, you'd like to review these on your own time, pick up the phone, request this report. Easy to go over, and a lot of details in addition to each one of these major points to consider. And that's what the planning process is all about. So if you'd like the list, or if you would like that complimentary review and that strategy session, 800-868-1194, the number to call. That is 800-868-1194, 800-868-1194, 800-868-1194, or you can skip the phone altogether. Always available online, McIntireRetirementServices.com, McIntireRetirementServices.com. Chris, it is always a pleasure having you here on the program. You always bring up great topics, important information, proactive strategies. We are closing in on the year end very rapidly, so another reminder to let's go ahead and put some intensity behind getting those year-end planning to-do items done, right?
Absolutely, buddy. And it's always good to be with everybody. Hope you're picking up some tips here along the way. Reach out to your CPAs, get some of your tax planning done here. If you need us, give us a shout at the office, folks. Have a great weekend out there. Stay safe.
Always a pleasure. Every time we get the opportunity to speak with Chris, if you'd like to speak to him yourself, pick up the phone, give him a call. 800-868-1194. That's 800-868-1194.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.